Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Ever wondered how traders lock in prices for oil, gold, or even stock indexes months in advance? Futures contracts let you do just that. These agreements are binding deals to buy or sell an asset at a set price on a future date, making them a powerful tool for hedging risk or speculating on price moves. They're popular because they offer leverage, meaning you can control large positions with relatively little capital. But that leverage can also amplify losses, so understanding how futures work is key before jumping in. Whether you're looking to diversify your portfolio or protect against market swings, futures trading opens up opportunities, if you know the rules of the game. Understanding futures contracts. At their core, futures contracts are standard agreements to buy or sell an asset, like oil, wheat, or the S&P 500, at a fixed price on a future date. Unlike informal handshake deals, these contracts are traded on regulated exchanges with strict rules to keep things fair. Think of them as a handshake with legal muscle behind it. How do they differ from options? While futures bind both parties to follow through on the trade, options give the buyer the choice to walk away. And unlike stocks, you don't own the underlying asset until the contract expires. Instead, you're speculating on price moves or locking in prices to avoid surprises. Every futures contract has standardized terms set by exchanges, like the contract size, expiration date, and tick sizes. This keeps trading efficient, no haggling over details. Key components of a futures contract. Every futures contract is built on a few non-negotiable elements. Underlying asset. What's being traded, like crude oil, corn, or the Nasdaq 100. Expiration date. The deadline for settling the contract. After this, the contract ceases to exist. Contract size. How much of the asset one contract controls. For example, one gold futures contract covers 100 troy ounces. Price, futures price. The agreed upon price for the future trade, fluctuating daily based on supply and demand. Missing any of these? The contract isn't valid. Exchanges enforce these standards so traders know exactly what they're getting into. Types of underlying assets, commodities versus indexes. Futures aren't just about physical goods. They cover two broad categories. Commodities. Tangible assets like oil, coffee, or gold. Traders here often deal with actual delivery, think tankers of oil or truckloads of grain. Producers and manufacturers use these to hedge price risks. Indexes. Financial benchmarks like the S&P 500 or Nikkei 225. These are cash-settled, meaning no physical goods change hands. Traders speculate on market directions without handling stocks directly. Commodities appeal to those in agriculture or energy, while indexes attract stock market players wanting broader exposure. The role of clearinghouses in futures trading. Here's the safety net. Clearinghouses. Every futures trade goes through one, acting as the middleman between buyers and sellers. Their job? Guarantee the trade. They ensure both sides honor the deal, even if one party goes bust. Manage margin requirements. Traders post collateral, margin, to cover potential losses. Clearinghouses adjust these amounts daily based on price swings. Settle trades. When contracts expire, clearinghouses handle payments or deliveries smoothly. Without clearinghouses, futures trading would be far riskier. They're the invisible glue holding the market together. Futures might seem complex, but they're just structured bets on future prices, with rules to keep things honest. Next, let's look at how traders use these contracts to profit or protect their interests. Why invest in futures contracts? Futures contracts aren't just for Wall Street insiders or farmers locking in crop prices. They offer unique advantages for everyday traders and investors looking to manage risk or capitalize on market movements. Whether you're hedging against price swings or chasing high-reward opportunities, Here's why futures might belong in your strategy. Leverage and margin requirements. Futures let you control a large position with a fraction of the capital. This is leverage in action. Instead of paying the full price of, say, 1,000 barrels of oil up front, you only need to post a margin to open the trade. But leverage is a double-edged sword. Amplifies gains. Small price swings can lead to outsized profits. Magnifies losses. If the market moves against you, losses can exceed your initial margin. Exchanges set minimum margin requirements, but brokers may ask for more. Always know your risk tolerance before using leverage. Hedging against price volatility. Farmers, airlines, and manufacturers use futures to lock in prices and avoid nasty surprises. If you own stocks or rely on commodities, futures can act as insurance. A wheat farmer sells futures to guarantee a sale price, even if market prices drop. An airline buys oil futures to stabilize fuel costs before prices spike. Hedging won't make you rich, but it smooths out uncertainty. It's like fixing your mortgage rate instead of gambling on interest hikes. Speculation and profit potential. Traders love futures because they're liquid and transparent. With tight spreads and around-the-clock trading on many contracts, you can profit from both rising and falling markets. Consider this. Go long if you expect prices to climb. Go short if you predict a drop. No need to borrow assets like in stock trading. Futures also react quickly to global events. A drought in Brazil might send coffee futures soaring overnight. If you spot trends early, the profit potential is real. Just remember, speculation requires discipline. Prices move fast, and emotions can wreck a strategy. Stick to your plan. Risks and challenges of futures trading. Futures trading isn't a guaranteed profit machine. While the potential rewards are real, the risks can hit hard if you're unprepared. Volatile markets, margin calls, and a steep learning curve trip up even experienced traders. Here's what you need to watch for. Market volatility and price swings. Futures prices don't move politely. Droughts, geopolitical tensions, or surprise economic data can send markets into sharp spikes or plunges within hours. The leverage that fuels big wins also means those swings hit your account faster. Unexpected gaps. Prices can jump overnight, skipping past your stop-loss orders. Liquidity crunches. Thinly traded contracts may not fill at your desired price. Emotional trading. Quick moves tempt you to abandon your strategy, don't. Trading crude oil? A single OPEC announcement might shift prices 5% before lunch. Volatility isn't bad if you expect it, but guessing wrong burns cash fast. Margin calls and liquidation risks. Brokers require margin as collateral, and they'll ask for more if the market moves against you. Ignore a margin call, and they'll close your position, locking in losses. How it happens. You buy a corn futures contract with $2,000 margin. Prices drop 10%, and your account can't cover the loss. The broker demands more funds or exits the trade. Some traders get wiped out because they overextended. Always keep spare cash in your account for margin bumps. Now that you understand the core concepts behind futures contracts, you're ready to dive deeper into their benefits, risks, and how to start trading. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.